Hello folks, Sid Miramontes here with Miramontes Capital's weekly market update. This week in news we have Microsoft reporting better than expected earnings from their cloud storage businesses. We have Ambev closing its $100 billion merger. And we have the market sitting at near all-time highs, so we're going to keep a close eye on what's happening with the markets, folks, to make sure when the point is we're going to start looking at deleveraging these portfolios to take some of the risk off to make sure that we keep those gains that we've made. This week I'd like to cover why I believe the 60-40 mix of a portfolio is broken. What is a 60-40 mix? It's what's considered to be a balanced portfolio where 60% of the money goes into stocks, 40% of the money goes into bonds. In the last 60 days, I've met with somewhere in the neighborhood of about 45 referral clients. Our clients have referred someone else that's not happy with their advisor, not happy with their current portfolio where they currently have their investments housed. And the majority of these folks, I've seen their portfolios have a balanced investment portfolio. But the problem with that is, folks, is that most of these folks are withdrawing on $1 million, say, for example, they're withdrawing somewhere between $45,000 to $50,000 a year. The problem that we have is that these portfolios, these balanced portfolios, why I believe they're broken, is because they're only paying a couple percentage points in interest and dividends. And so what's happening is, for example, if you're pulling out $45,000 a year to live off your $1 million, and it's only paying you 2 percentage points or so in interest and dividends, well, we're having to sell $45,000 worth of shares every single year, this year, next year, the year after, and on and on and on and on and on forever. And the problem that you come into is that one day you can run out of shares, okay? So one thing I want you to take away from this video is, if you take away nothing else, that we must make sure that your portfolio pays out enough dividends to cover the withdrawals that you're pulling out of it, or you're going to be selling shares every single month. You might say, well, while I was working, that worked. Well, that is correct, but you weren't selling shares when the markets went down. Now you are. Now you're selling shares every single month. So even if the stock price stays the same, you have to sell so many shares every single month. Next month, you sell so many more shares. Next month, you sell so many more shares if you're selling on a monthly basis to give you your income. So what has to happen is, as I've noticed from all these recent meetings, and I've noticed this for years, the past several years, folks, this 60-40 mix is not going to give you what you need. You need an actively managed portfolio where you have an advisor that's going to actively monitor what's happening. We have what's called our constant communication and analysis model, where we check in with our clients every 30 to 45 days to make sure that everything is in line, where we communicate with you. We call you via Skype or personally on the phone or one-on-one to make sure that that portfolio is in line with what your needs are. Otherwise, folks, if you're stuck with selling on a month-to-month-to-month basis, you're going to run out of shares. And that's not going to work, obviously. Folks, I'd also like to thank you for, our recent publication that we have coming up in Forbes magazine. I'd like to thank you for being rated one of the top California's financial leaders. Also, Financial Advisor magazine just came out and rated our firm as one of the top registered investment advisors as well. So I'd like to thank you for that as well. Thanks so much for the accolades, folks. And if any other questions like those, why I believe the 60-40 mix is broken, or others, please call or email us. Thank you for your time.